Hello there, this is James, and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Tuesday. In today's program, I want to talk a little bit more about the earnings season, because as I mentioned yesterday, the earnings season is now in full swing. But how this earnings season is so far been reasonably okay, but now's not the time to disappoint the market. As well as that, I want to talk about, are we actually now beginning to see signs of cracks in the US economy? But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, I wanted to really talk about a little about this earning season so far, and why is not the time to disappoint the market with your Q3 earnings. And this is a big week for earnings, because as I mentioned yesterday, we have the likes of Microsoft, Alphabet, which is Google, Meta, Facebook, Apple, and Amazon, some of the world's biggest companies. Microsoft and Alphabet, Google come out tonight after the market close. Facebook is tomorrow, and Apple and Amazon are later in the week. I already spoke about, the one I'm going to be interested in, which would be Facebook. But here's the point I want to discuss, because so far, okay, 1/5 of the S&P 500 companies have reported their Q3 financial results. And the market's holding its finger, crossing its fingers, has its fingers crossed, hoping for the best. Because so far, 72% of those companies, the fifth of the S&P, have reported earnings per share better than estimated. So 72% have beaten estimate the fifth of those companies. 72% has reported better earnings per share than estimated, which it sounds quite optimistic. But if you look on the 5-year average, over the last 5 years, that number of companies who beat estimations was 77% over the last 5 years. So again, we're seeing a slight drop off. The 10-year average actually is 73%. So 5 years is 77. And we're seeing 72% of those companies have beaten expectations. So could you say we're having a good earnings season so far, or slightly below average earnings season? Now, here's the other thing. Okay, same as time. We've had, a reasonable earning report, but on average, over a 2-day period, okay, the companies have their stock price has bounced by 0.2% after releasing their earnings announcement. Okay, by 2% on average over a 2-day period after the announcement. Again, this goes to what I want to talk about. Again, the 5-year average of companies who report better earnings over 2 days is 0.9% bounce upwards. What else is also worrying, which is also concerning, companies that have disappointed with their earnings have fallen on average over a 2-day period after announcement by 5.6%. The 5-year average of companies reporting disappointing earnings, they usually fall over a 2-day period on average by 2.2%. So it says to me that we are having a reasonable earnings season. It shows to me that the market is pretty, being very cautious. If you have better than expected, then you get a smaller bounce. But if you get worse, you get a worse decline than normal, showing that the market is getting a little bit nervous. I mean, we've got two examples here I want to talk about. Okay, first of all, Netflix. They had far better earnings than anticipated. In fact, they announced that they had increased their subscribers by 2.5 million. And the expectation was 1 million. Plus, don't forget the forecast for growth, especially with their ad revenue plan, is painting a very rosy picture for the streaming giant. So they rose 13% with better earnings. Snap Incorporated, or Snapchat, whatever you want to call it, they reported negative, a lot worse earnings than anticipated, and they fell by 28%. So Netflix did a lot better, and Snap was pretty much on par with negative earnings from quarter two. It wasn't dramatically lower than quarter two, but it was still pretty negative, and they fell by 28%. And don't forget, Snap is down roughly about about 60, between 60 and 70% year on year. So it goes to show to me that the market, good news, they celebrate a little bit. Bad news, they run, even if the bad news is not that bad, they run for the hills. So this is why this is not the earnings season to have disappointing earnings. So I really think, obviously, Microsoft and Alphabet tonight, after the market is closed, will release theirs. That will be really interesting to watch. And of course, obviously, Facebook tomorrow as well. That would be really interesting to watch as well. Now, before we have a quick look at the market, where the market stands, there's something else I want to briefly talk to you about as well. And I'm going to ask the question, is the US economy beginning to show, it's beginning to creak, beginning to show cracks? Okay, because we had two mediumly important economic data come out today. Okay, first off, we had US consumer confidence was released. And we all know what consumer confidence is how confident the consumer is in current economic conditions. And that was announced at 102.5 versus 106.5 expected. So going to show that the US consumer is beginning to get nervous about the current economic climate of the United States. So it's beginning to get a decline. The other thing as well, and this is something I've talked about a fair bit in quite a few of my videos, we had some US housing data come out as well. Case-Shiller house price indices was announced at 13.1% versus 14.4% expected. The previous reading for this data was 16%. Now, just for those of you who don't know what the Case-Shiller is, that's S&P. It's actually S&P Case-Shiller house price indices. This measures the change in the price of a single-family home. Okay, a selling price of a single-family home. So we're going to show that house prices are beginning to decline. Obviously, clearly, because of the current climate. Okay, there obviously demand is waning because mortgage prices are going up quite considerably. Why? Because obviously the higher interest rates, and obviously consumers are getting more and more nervous to spend their money. So this is just a bit of data here showing that, especially the housing market. I talk about the housing market a lot because I really think that's going to become a very big story again in the future. But it's beginning to show bit by bit, potentially the US is creeping in to recession. And as the market currently opens at the moment, we are seeing a little bit of dollar weakness across the board. But let's have a quick look at it now, actually. Let's start off with my favorite, good old gold, the yellow metal. That, as you can see, has had a bit of a boost with weaker dollar, and bond yields down as well. The reason for it, because again, like everything, the market tends to anticipate that if we get bad data, the Fed's going to cool off on its Fed interest rate hikes, which it won't in November, maybe in December it will. But anyway, it's currently up slightly, higher on the day, $1,656.48. Still a little bit away from that key level, though, of $1,667.86. That, to me, is a really key potential area of interest. Euro as well is up for the day. We look at a short term. You can see that's had a bit of a boost on the back of dollar weakness. Currently trading at 0.9447. Sterling, which was having a bit of a better feel today because obviously the new PM, the market's a lot more comfortable with. That's currently trading at 1.11465. This is going to be an interesting thing to watch as well because I talked about the sterling. Obviously, we've got a little bit of a rise on that, so it's definitely up for the day. But key for me, and this is also what ING indicated, is the 115 handle. 1.115 handle. Can it break through that? Because that is potentially a key resistance level. So that will be something to looking at as well. If we move on to the indices, okay, as you can see, the S&P again is slightly up for the day. Not really paying attention to that sort of slightly worrying consumer confidence, more sort of looking at it as, okay, we're getting this negative data. Bad news is good news, which means the Fed won't do anything. So that's slightly up for the day. And obviously NASDAQ as well, that's slightly up for the day, 11,580 points. Of course, it's all going to be about these earnings, Microsoft and Alphabet today. So that's going to be really interesting to keep an eye on. So other events to come. Obviously, we've got Canadian interest rate decision tomorrow, ECB interest rate decision on Thursday, US durable goods, German GDP, and German CPI still to come. European equities as they currently stand. FTSE slightly negative 0.43. DAX currently trading in the green, 0.29% higher. Euro Stock 50 currently trading in the green as well, 0.96% higher. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like. Say hello, or share me your opinion, what you think. And like I always say, if you think of a question later, you can put it in the comment section, either on YouTube or Facebook. I will see them, and I will reply to them next time I go live on air, which of course will be tomorrow at 8:30 a.m. UTC, the current European session, and again, right, so probably around about the afternoon as well, to cover the US session, 2 p.m. UTC. Okay, well, I'm going to do a soft launch on this new announcement. I will be doing a new education series starting tomorrow. I was talking about it a bit more about it in the morning, but it's going to go through some teasers. It's a new series. So I'm going to do a soft launch, and I will be doing that tomorrow, and I'll share some more information on that when it comes out. But thank you for remembering. Yes, it'll be tomorrow will be a new educational series. I'll give you the name. It's called Tixee Live Presents the Trading School. And tomorrow we're going to be covering a subject of fundamental analysis versus technical analysis. Like I say, it's the first one. It's a pilot, but like I say, I will make a bit more information on it, and this will be a bigger series as we develop. So keep an eye out for that. Okie doke. Anyway, if there is no other questions, well done for remembering that. Don't forget. If you're watching me on Facebook and you enjoyed this little episode, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, found it interesting and useful, subscribe if you like. If you enjoyed this little video, found it interesting, useful, and you put up with me, my over-the-top enthusiasm for the markets, then give me one of these. It's nice to know that you like what I do. But anyway, till next time. Don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do. Oh, good job, sir. Oh, thank you very much. Thank you. I really appreciate it. I'm glad you like it, sir. I hope you're having a great day, and your family as well. Thank you very much for that nice comment. I really, really appreciate that. So yeah, as I was saying, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.